You shouldn't have the same portfolio in your retirement years that you do in your working years. And in today's video, I'm going to walk you through how soon before retiring you should begin to make some of those portfolio adjustments. Hey everybody, I'm James Conole, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. It's common knowledge that when you're working, you can afford to be in a more aggressive growth portfolio because you're not dependent upon that money. You can invest through the ups and downs of the market because you know that you have time on your side for the market to recover when you go through downturns. In retirement though, it's a different story. You don't have all that time and your portfolio should be structured differently to protect and insulate you from some of the negative impacts of those market declines. The question is, when do you start making the transition from your growth portfolio in your working years to your retirement portfolio in your retirement years, and what should that transition look like? Well, to start, let's back way up. When we look at stocks are an incredible way to grow your money. When you own stock, you own a company. When you own the company, you have a right to that company's future revenues, profits, earnings, etc. This is one of the best ways to grow your wealth over time. You can invest your money, and without any effort on your part, no attending meetings, no management responsibilities, no anything within that company, your money can grow. And historically, the S&P 500 index that tracks the largest companies in the United States has grown by over 10% per year. Now, if we could count on that 10% per year every single year, there really wouldn't be any need to own bonds or conservative investments or cash in retirement. We would just keep growing and be taking what that money grows by each year. The challenge is it doesn't do that. The challenge is the stock market has averaged 10% per year historically, but it's never once returned to exactly 10%. It tends to be much higher or much lower, and when you average out those annual returns, that's where the 10% comes from. Here's some helpful context so that we can make sure that as we're looking at stocks, we still need to harness the power of what they can do in retirement, but we also need to mitigate the negative impacts that they can have in our retirement. What are those negative impacts? Those negative impacts are downturns or temporary loss of money. Well, to mitigate that, we need to understand how long those downturns last for so you can have a strategy to protect against that, especially as you're starting to transition to a retirement portfolio. Well, here's some data that might help with that. On average, 52% of the time, the S&P 500 goes up on a daily basis, and 48% of the time, it goes down. So you have a very high likelihood of both making money or losing money on any given day. It's about 50-50. Now, at a monthly basis, it's about 2 out of 3 times. So 67% of the time, the S&P 500 is up, 33% of the time, it's down. On an annual basis, about 3 out of 4 years, or 75% of the time, the S&P 500 has a positive return, and 25% of the time it has a negative return. At the 10-year mark, it's about 95% of the time that has a positive outcome, 5% of the time negative outcome, and once you get to 15 and 20 years, there's never been a time where the S&P 500 has had a negative outcome. So what? What does that information do for us? How does that help us understand how we transition from an accumulation portfolio into a retirement portfolio? Well, it helps us because of this. Let's assume you have 20 years until retirement. Well, there's never been a negative 20-year outcome in the S&P 500 with the dividends reinvested. So that to us is maybe way too far out to start making that adjustment because as we're looking at this, we still have time on our side to ride out the ups and downs of the market. But as you go from 20 years out to 10 years out to 5 years out to 6 months out, well, our time horizon keeps shortening. And as our time horizon shortens, the less and less certain we can be that we'll have a positive outcome from our stock investments. Now I'm just using the S&P 500 here. If you have a more diversified portfolio that also has small companies and international companies and emerging markets and real estate, et cetera, well, these timeframes are condensed because you're not so concentrated in just one asset class, but this is helpful context because what it tells us is it tells us that we can count, at least we can have some confidence in the growth portion of our portfolio having a positive outcome after some period of time, but we need conservative assets to fill in that gap in case we retire and we don't have a market that's going up, but we instead have a market that's going down. So what do I like to do? Well, about 10 years before retirement, I at least like starting to have that conversation. Does it start to make sense to get gradually more conservative? And again, the goal is not to be super conservative or 100% conservative by the time that you retire, but it's to have that right mix of conservative and growth investments. But rather than making that change all at once, say overnight the day that you retire, you want to start thinking it's like landing a plane. How do we slowly start to make course corrections so by the time that you retire, you're fully there? Here's an example of why that really matters. What we're looking at here is during this time period from 1976 until August of 2022, we're looking at the returns on the S&P 500 versus the returns on the aggregate bond index. What this is showing us is both the average return that you could have expected from these different investments, as well as the range of returns that you could expect over any given time period. So for example, as you look at this, bonds, the one-year average return was about 7%. Stocks, the one-year average return was about 12.8%. So it's clear that stocks had a superior average return, but what they also had was far greater or far less consistent range of outcomes. So look at this range of outcomes here in stocks. You could have been up 61% in a year. You could have been down 43% in a year. That's a huge range of expected outcomes. There's no certainty as to what you're going to get within that very broad range. Now bonds, the high wasn't as high. It was up 35% in their best 12 months. The low was down 11.5%. And by that way, that's the 12-month period that just ended. Bonds are getting hit really hard right now as interest rates are rising. So what you get with stocks is you get a really large range of potential returns. In exchange for that, you get a higher long-term average return. With bonds, that range is condensed. Your good years aren't going to be as good, but your bad years aren't going to be as bad. And in exchange for that, you get a lower average long-term return. Now let's fast forward to 5 years. Let's see what that looks like here. Well, at 5 years for the S&P, you can see the range of outcomes here. For bonds, it's more narrow, which is what you want in retirement. You want something that has more consistency, not as wide of a range of outcomes. For stocks, the highest was about plus 30% per year for 5 years. The lowest was losing 6.6% for 5 years on average. Well, with bonds, what you see is the high isn't as high, 20% per year. That's still a really, really great return. That's coming out of really high interest rates as interest rates started to fall. And even the lowest return in bonds, it's still a positive outcome. So that's what you're looking for in retirement, is how do we start to have part of our portfolio where there's greater consistency of outcome? You know, the range of potential outcomes isn't as sporadic because what you need to be able to do is you need to be able to count on a part of your portfolio to be there for you in those years that you need it. I mentioned before, you don't want to be 100% conservative investing in retirement. And the reason for that is look at this. Over 20 years, even if we look at stocks' worst case scenario, this is the S&P 500, worst case scenario, they were up about 4.8% in a year. Well, bonds' worst case scenario, they were up 3.39% in a year. So even the worst case scenario for stocks, which are going to grow a whole lot more over time, was still a better outcome than the worst case scenario for bonds over that time. So think of bonds as a way to mitigate that short-term risk, or cash as a way to mitigate that short-term risk. But if you do too much of that, you're now just taking your risk in your latter years because you're not getting the growth that you need. So as you're working and you have your accumulation portfolio, your growth portfolio, the first step is understand what should your target retirement portfolio look like. It's going to be a factor of what do you need in conservative investments, plus also what's going to make you feel most comfortable, what's going to allow you to ride out the ups and downs in retirement. So understand where you are today, understand what your target is in retirement, and generally speaking, about 10 years out, that's typically when I start to recommend people make those changes. Could be sooner, could be later, depends on your specific situation. But the goal is to say, how do you avoid going from one portfolio today to a completely different portfolio in retirement, and instead going from where you are today, understanding when do you start to make those changes, and those changes are based upon what range of outcomes can we expect. So how do we mitigate against worst case scenario in our growth investments, and start to gradually make those shifts from the time that you begin until retirement, so that when you do retire, it's almost like a smooth landing. You have that portfolio that you need, you're invested the right way to be able to keep up with the growth over time, but also protect against market downturns over time, and you've done so in a very elegant way, as opposed to having two clashing portfolios that happens very abruptly right when you retire. So this video is all about that adjustment period, typically about 10 years out, and then gradual adjustments until you get to that perfect retirement portfolio for you. How do you know what that perfect retirement portfolio for you looks like? Well, there's some structure that you can take or a framework you can apply to your situation to understand exactly what that looks like. And to learn more about that, be sure to check out this video above. Once again, I'm James Conole, founder of Root Financial. And if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.